Oh, I did. Okay, yeah. Okay. Surprising. That one seemed harder than seemed harder than last quiz. They gave us multiple attempts on the last.
That's a lot.
Well,
The last one is just divided by the outstanding.
And
I'm not sure.
the last quiz, I was for the one we took on Sunday. That one seemed easier than this one we just took, but he gave us multiple attempts on that one. I'm surprised he gave us multiple attempts on that one. This one.
Yeah, I did too. And then
But I think this one is,
so I don't, but then they like put any feedback.
oh, I know, of course.
Around it.
That's
So
true.
Make the whole question open.
Which is stressful because it's like, we can know our grade in a day or we can know in a month from now. It's like, I want to know how I did.
Tasha, where is Lahore? How do I say your hometown? Lahore, where is Lahore Times? Whereabouts relative to just between India and, yes,
China.
yes, what's the capital of Pakistan? Islamabad. I know where Islamabad is on a map. So
Oh,
where
it's
is Lahore?
below.
It's below, so closer to the
So
ocean.
like 4-5 hours, right?
All right, what's the climate like over there this time of year? Online.
Right now.
Yeah,
Very it's cold, hot, cold.
about like this?
Yes, kind of.
Do they get a,
But,
do you get a real winter over there?
but it's winter.
Can you ski anywhere in Pakistan?
Yes.
You can? They have ski resorts? I mean, do you ski?
Yeah, no.
Put it on your bucket. That's fantastic.
Drive yourself.
What's one of my favorite things? Never skied Pakistan.
Steak, this is your favorite model to teach, right?
My favorite module, right? Yeah, and trick or treat is, I saved this one.
Show you
For a reason.
where this. So I think that. It's complicated. Yeah, the formulas of you. That's what I was thinking. When I was. Well, it's like. change.
Sam, you kind of went incognito with this picture. It's taken me till week 11 to put 2 and 2 together here. When did you have this hair in this picture?
About 2 years ago.
You gave me a picture that was 2 years old.
It's the only like professional looking photo I have.
And you've got hair almost down to your shoulders. Okay. I like it. Okay. Where do you play pickleball?
Here mostly.
UMKC has a pickleball court?
Kind of like next to basketball courts.
Okay. Is that a rec league sport now?
Yes.
So you can play.
Yeah.
Okay. That's that's a real, that's real deal. You can go, I mean, I was watching pickleball on ESPN not too long ago. I have a friend in Indianapolis he's my age, but he plays, I guess it's the Masters League State, or whatever that event would be. He's playing for it. He's into it big time. So, gotta be into something. Which 5:30, so I'll get started here. Oh, thank you. The reason we're meeting tonight is my schedule doesn't allow me to be here Next week would have been our regularly scheduled meeting. I was planning on lecturing on module 11, but since we're on module 10, I'll lecture on module 10. And it is a good trick or treat lecture since we get to talk about leases, pensions, and taxes. Leases aren't so bad. They changed the accounting for leases in 2019. And I would love to be able to tell you that you could take the old lease accounting and just forget about it. But you know, that's not what I'm going to tell you. I'm going to tell you, you have to know it because you're likely to run across accounting and numbers from 2019 and you want to make sure that you're comparing apples to apples. So you got to know the old and the new, and you got to be able to reconcile for the old and the new. Fortunately, the new is a lot easier. So if you just know the new going forward, you're probably all right. Pensions, we touched on last week when we were talking about other comprehensive income. Pension accounting is one of these unusual areas of accounting where if you just looked at the change in the underlying economics from one period to the next, you can get huge billion-dollar swings in what a company owes on their pension accounts. So FASB lets accountants smooth out those numbers over time. And there are some rules that we have to adhere to when we smooth those out. And we need to be knowledgeable of how those rules are put into place so we can make adjustments and hopefully catch any shenanigans that might be going on inside the company, because there are a lot of estimates that have to be factored into the accounting for pensions. And then lastly, taxes. Maybe it's just a mental block that I have, but I find the accounting for taxes as it relates to GAAP, one of the most challenging aspects of financial accounting. Probably for me, it's the most challenging. And when I was a student at UMKC over 20 years ago, there was a professor named Dr. Larry Kruger. I think he's still got an office upstairs. I think he's emeritus now, but he taught that class. Accounting for taxes, and it was a terrific class because he was a personality, and he'd stand. I thought he was going to break his hand beating on the pulpit from time to time, getting so excited about accounting for deferred tax assets and deferred tax liabilities. One of the most challenging classes I ever took while I was here at UMKC, and some of it stuck around. So we're going to talk about deferred tax assets and deferred tax liabilities. We'll just briefly touch on it, and know, please, that if you ever want to, you can spend an entire semester on the 1/3 of an hour we will devote to that topic tonight. So your learning objective for tonight's class is just to really be able to understand what a deferred tax asset is, understand what a deferred tax liability is, be able to explain the difference between the two, and maybe go a little bit deeper into an example of how they occur and post to the financials. So that's our intro for tonight. Any questions about the exam or research project or homework or anything else before I jump into it?
Said November 8th, right?
I think that's what we decided. When you all go out onto the My Business Course website, can you see the
When I
dates?
clicked on when I clicked on this.
You can't see the dates, okay. Well,
Last time we could.
what do you mean last time?
So for test 1, when we clicked on it, it said the deadline for the test.
Oh, yeah?
But when I click on test 2, it doesn't have any deadline. It just says, talk to your professor about.
Okay, well. Eric, I see you're in the Zoom room. Can you hear and see everything okay?
He's in the way.
Oh, well, thank you.
Module A says to.
Hey, Eric, sorry it took me a minute to let you in there. We haven't done anything yet. I'm just doing a little Q&A. Can you hear me all right?
Yes.
Okay, exam 2. Need a timing. Open until November 8th at basically midnight. So yes, I don't know why you're not able to see that when you log in. If you could, the first one. I'll use time outside of class to troubleshoot that one. But the answer to your question is November 8th. So got a whole nother week to put that off. All right. Okay, let's talk about the accounting for leases, pensions, and taxes. We're going to talk about leases first. I cannot operate. Sorry, can't read. There we go. I think the animations, when it brings in one bullet point at a time, it drives me nuts. My pet peeve. My pet peeve, if anybody cares, is when I go to watch the local news. Tune into the local news, right? You want local weather, you want a little bit about what's going on with traffic stops, anything else going on local. And they try to give me coverage of Tom Brady and Gisele's divorce. I don't want to know about Tom Brady and Gisele when I turn into the local news. All right, leases. The first few slides in this chapter start off by explaining to us what a lease is, some of the common contractual terms, how they engage the lessee and the lessor. What's the difference between the lessee and the lessor? Can anybody answer that one?
One is the owner of the asset.
Yeah, which one is the owner of the asset? The lessor is the owner of the asset? I don't know, I get those confused all the time, which is the owner of the asset is the lessor. Yes, that is precisely right. And the party desiring to use the asset is the lessee. So just star that. It's simple terminology. Is anybody in here not familiar with the way a lease works? Let's just tie this back to something that I would expect most people to be familiar with, which would be a lease on a car. I don't see anybody shaking their head no, so we'll call that a fairly simple transaction. You're not buying it, you're just agreeing to use it, and in exchange for that use, you pay a fee on a monthly basis. And the contract usually identifies the term of that relationship, 36 months, 60 months, sometimes 72 months. And at the end of that engagement, that asset goes back to the lessor. Pretty simple. Now, we have two types of accounting. These leases will be classified as a finance lease or an operating lease. Both of those types of leases result in the asset being reported on the balance sheet. And that is the primary difference between the way we account for leases today versus the way we accounted for leases in 2019. If you go back to 2019, an operating lease was not reported as an asset on the balance sheet. So if you're trying to compare apples to apples, the total amount of assets listed on your balance sheet would be understated as of 2019. Those are your primary differences. FASB took a look at that accounting as of 2019, and they came to the determination that too many companies were utilizing operating leases that were de facto purchases. Meaning that if you code something as an operating lease and you say you don't own it, so you don't have to put the asset on your balance sheet, and correspondingly, you don't have to put the liability on your balance sheet. If you buy a home, well, that's an asset, but you also have a mortgage that you have to pay for, sometimes for 30 years. That's a liability. And you got to record both of those if you buy a home. Well, what FASB observed companies doing was structuring that basic transaction that had 90% of the tenants an ownership would have, but they would structure it as an operating lease so that they could keep all the liabilities off their balance sheet. And they looked through that a little bit and they said, no, let's just make it so that anytime there's a lease, no matter if it's operating or finance, the asset goes on the balance sheet. And then we'll make some adjustments for what the value of that asset is. And I'll show you those definitions here on the next slide or the slide after that. And they're not too onerous. Here's an example of what you're going to see when you look at the 10K filings for the companies in your research project. You're going to see these broken out. You're going to see the finance leases reported with property, plant, and equipment. And then you're going to see the operating leases on a separate line item. These are assets. You can see here they're reported on the balance sheet as assets, but they have their own special nomenclature that in this case reads operating lease right of use assets. Assets being the most important one. As an analyst, that should be your signal to go to the back of the 10K filing and read the fine print about what happens at the end of that lease. At the end of the lease, oftentimes there's additional contractual liabilities. Maybe they have to buy that. They might have to have some cash reserve. There may be some obligations associated with that. It's always important as the analyst that you know what cash is coming due, what liabilities are coming due, what payments those are, and whether or not that might put financial stress on the institution trying to satisfy those payments at a particular point in time. Here's the liability side of the balance sheet. As always, and nothing new here, the balance sheet is broken out by time. All of our current liabilities show up first. So any current portion of an operating or a finance lease shows up in the current liability section. And you can see that the finance lease is broken out as simply long-term debt, just like any mortgage on a home would be. Operating leases are broken out as operating lease liabilities. So here are some of the terms that would differentiate an operating lease from a finance lease. Let's, for the sake of our conversation today, refer to the operating lease as something more conventional. Then when we see any of these terms, we need to say to ourselves as the financial analyst, oh, this is a finance lease. So we need to account for it just a little bit differently. So if there's a transfer of ownership at the end of the lease, well, that's a finance lease because we own the asset. And that's very common, where a lease will be over a period of time that's so extensive, all of the economic value of the asset is either gone or transferred by the time that lease runs out. So why not just pass the title? So if that happens, then you have financing. If there's a purchase option, a lot of times you'll see this referred to as a bargain purchase option. So maybe the title doesn't transfer, but the lessee has the right to buy the asset for $20 or something so insignificant that any business owner in their right mind would probably opt into that. A bargain purchase option. Lease term, if the lease term is for 99% of the economic value of that asset anyway, that's effectively a finance lease. You've effectively purchased that asset, so you want to account for it as a purchase. That's what a finance lease does. It accounts for it as a purchase. The present value of the lease payments is substantially the fair market value of the asset, or maybe you have a specialized asset that, I don't know, a lot of times you can lease a specialized or a customized piece of asset that only fits into a unique line, manufacturing line, in which case it's not going to be of any value to anybody else. So you have 100% of the economic value recognized by the lessee. And in that instance, you would go ahead and account for it as if it were a financing lease. So here's the accounting. A lease liability is going to be recognized at the present value of the remaining lease payments. Now that's a finance lease. The right of use asset is recognized at an amount calculated, and this should make intuitive sense. You have the amount of the lease obligation. To that, we're going to add any lease payments made by the lessor at or before the lease commencement date. So these are prepayments. We're going to subtract lease incentives received from the lessor. So, lines 2 and 3 there are just adjustments for any cash flows that might have changed hands before we signed the lease. You can almost disregard those. They're not particularly common. And then the initial direct costs of the right of use asset incurred by the lessee. So those 4 payments sum to give us the right of use asset. This is the number that shows up on the balance sheet. And it covers the rest of those points. Here's an example of what you might see in the footnotes. Where this is useful, again, is in the understanding that these payments are coming due. And therefore, your management teams need to have a strategy for, if they have the cash on hand, this isn't a problem. But if they have these payments coming due and 2 or 3 note obligations coming due, and maybe ability associated with some other derivative contract, and the list keeps on going, you have to keep track of all this because it's not uncommon for companies to find themselves in a real cash crunch. That's what we get paid to do as analysts, is to be able to see around the corner a little bit. So it's rare that you would look at a lease schedule and see a red flag going on. Like in and of itself, your company doesn't have enough cash to pay for the obligations that are required by those leases. But when you factor this in through more of a mosaic that forms a picture of the whole company, this plus other obligations might create real risk for the future cash flows of that business. So make sure you find this table and make sure you factor it into some overall solvency analysis of your companies. Okay, our authors here are giving us an example of how to compute the present value of the lease payments associated with any particular lease. I'm hopeful that this is all review. Everybody in this class should have had the opportunity in their first finance class to calculate the present value of an annuity table. If you need a refresher on that one, there are tables in our books and there are exercises in the text and in my business courses online that'll walk you through that. So this slide asks a good question. When you calculate the present value of any lease, and in this example, we used 3.15%, but in another example, It might be 4% or it might be 2%. Where does that number come from? So if you lease a car, you go down to your Toyota dealer and say you want a 4Runner, and you enter into a lease agreement, and you know what the lease payments are going to be in the future. What's the implied interest rate? That's factored in there. When you lease a car, they tell you what it is. It's in the paperwork that you sign. The implied interest rate is 3%, 4%, 5%. They tell you what they're charging you. And you can compare that directly to what it would be if you bought it outright. So if the car's value is worth 50,000 and you know the series of payments that you're gonna have to pay over the next 6 years, well, you can put all that into a spreadsheet and solve for the implied interest rate. So as long as we know what the asset is worth and the series of payments associated with the lease, then we can calculate the internal rate of return. That becomes a spreadsheet exercise in and of itself. So if we're not just out and out told, then we can use Excel to calculate what the internal rate of return would be associated with those cash flows. Okay, let's switch our focus to the income statement for a moment. The operating lease will report those cash flows as a lease expense on the income statement. So you rent a car, you're gonna have a lease expense associated with that car on a monthly basis, and then you'll report that periodically on the financials. We calculate that by taking the lease expense of $23,463, which is 117 divided by 5 years. So we take the total expense and we just divide by the number of years that we have to lease. We don't calculate any interest. We don't calculate any amortization. We don't treat it as if we own it. Just lease expense divided by time. Okay, operating lease is pretty simple. I already told you that we're going to account for a finance lease as if we owned it. Interest expense and amortization are the two things that show up on an income statement if we actually own an asset. So we're going to go ahead and book those. So with a financing lease, going to use straight line amortization. So for year one, we have a lease expense of 100,000 times 4% plus 105 divided by 5 is $25,000. Nothing particularly tricky about that. And I can probably guess where I'm going to draw your attention next. Depending upon whether or not we calculate or classify our lease as operating or finance, we have a difference of $23,000 worth of expense or $25,000 worth of an expense. And now we're playing my favorite game of find the penny. Management team has some discretion. We looked at 5 criteria 2 slides ago that differentiate an operating lease from a finance lease, but they're not all black and white. There's some room for fudge factor in there. So if you're coming up a penny short on your earnings per share and you need to reclassify an operating from a finance lease, that might be a place that you. Now, when you get into the nitty-gritty of doing the analysis work on your semester project, very few of you are probably going to have lease accounting as something that you need to worry about. The companies that have to deal with this in a big way are like Southwest Airlines. Most airlines lease most of their airplanes. So if that's your business and you're leasing 90% of your fleet, all of a sudden accounting for leases plays a big, big factor in how you're running your business. Other companies like Microsoft, I doubt Microsoft has any lease accounting that's material. Materiality is a huge component of being a good financial analyst. You got to be able to sort through all this, whatever we've been looking at all semester long, and make heads or tails of what's material and what's not material. So that's part of the skill set that we're trying to develop in this class over 16 weeks, is for you all to be able to put on your analyst hat and quickly identify what needs a deeper dive and what doesn't. So if you're not Southwest Airlines and you're Microsoft and you have lease accounting that maybe it does look a little bit funny, but it's not material. They're just simply not leasing enough assets to change the recommendation that you would ultimately arrive at, having completed a thorough review of the company. Yes, ma'am.
So going back to that comment you made about how, you can play find the penny and move a finance lease to an operating lease to adjust. How many of those criteria for a finance lease have to be met to then quantify it as a actual finance lease?
There's no hard rule. It's subjective. Any single criteria, if it's met, can trigger that operating lease becoming a finance lease. The most black and white of those 5 that I had on the screen would be the transfer of the title at the end of the lease. That'll be in the contract. That's black or white. Okay, so there's not a lot of interpretation there, but X% of the economic value, and I think the wording was, if a substantial portion of the economic value is used throughout the life of the lease, then it's a finance lease. Well, what is substantial portion of the economic value? Okay, now there's one.
Right.
I'm gonna make that read how I want it to read when I need to find a penny. Okay. And that's how a lot of it. Some of it's easier to manipulate than others. Okay, Delta Airlines, 2 examples of how they report their leases. Let's check that out on your own time. One point I will make on this slide is that operating leases and capital leases or finance leases, those terms are interchangeable. They affect the statement of cash flows differently. So if it's an operating lease, the payments will come out of the operating section of the statement of cash flows. If it's a capital or financing lease, at least part of those payments will come out of the financing section of the statement of cash flows because they're associated with interest payments. And all interest payments are associated with debt, and therefore the financing of the business. It's typically a small distinction, but it's one you all need to be aware of. Exhibit 10.2 is a good one. You might just star that one, come back to it. Differences in how financing and operating leases are reported across all of the financial statements. And then the same story on slide number 21. Okay, then I'm zipping on to pension disclosures. So we'll talk about pensions. Bear with me here a moment. I want to make sure I didn't skip over anything that I had intended to talk about. Nope. Okay. Okay, pensions. We're going to talk about 2 kinds of pensions that you see most commonly are a defined contribution and defined benefit. Anybody in here participate in a 401k plan? Okay, well, you all will participate in a 401k plan after you graduate, get the ideal job, Got the master's or undergraduate degree on your resume and go to work for most companies in the United States offer a pension plan of some kind. And in I think it was 1972, the US Congress passed a piece of legislation called ERISA, the Employee Retirement Income Securities Act. And there's a portion of that act it's actually section 401K of that act outlines the rules that govern a pension plan called defined contribution. So these are pension plans that give employees the opportunity to contribute part of their paycheck every period, tax-free, into an investment account. And those monies grow pre-tax throughout the investing lifespan of the typical worker. So if you retire, if you enter the workforce in your 20s and you leave the workforce in your 60s, you have 40 years to compound that growth tax-free. That's a pretty good deal. That's called the defined contribution strategy. And it's very easy to account for because the company is not typically on the hook for any liabilities associated with that. It's the individual employee decides how much they want to contribute, and then those monies go into a trust account. And they're held there until that employee wants to withdraw them, typically at the near retirement. That's called a 401K account, or you might hear that referred to as defined contribution. There are other types of defined contribution accounts. If you're in the world of academia, you're governed by another section of ERISA called 403B. 401Ks and 403Bs function almost identically, but technically they're governed by different paragraphs of the ERISA legislation. Governmental accounts are called 457s because they're governed by paragraph 457 of the ERISA legislation. Prior to ERISA, most of the United States anyway, utilized a pension program called defined benefit. Defined benefit plans do exactly that. They define the benefit a retiree will receive at the age of, pick a number, typically 65. Most of them are structured so that when you retire at age 65, the company will guarantee you 80%, I'm using common numbers, but they vary widely. Company will guarantee you 80% of the salary, 80% of the average salary that you made in the last 3 years of your tenure at that business for your life and the life of your spouse. So these programs worked very, very well. The first one to ever be launched, I think, was American Express back in like the early 1900s. And they funded successful retirement outcomes for a generation of Americans. My grandfather passed away in 2002. He retired in 1985, having spent over 30 years working for Phillips 66. So from 1985, when he retired, to 2002, 17 years, Phillips 66 sent him a check every month. And it was about what he was making when he retired. So they were supporting his standard of living. And that was good for not only his life, but his spouse's life too. So my grandmother is 96. She's still alive, still gets a check from Phillips 66 in the mail every month. So that's 1985 to 2002 is 17 years. 2002 to 2022 is 20 years. So for 37 years, Phillips 66 has been sending a check to 611 West Washington, Kingman, Kansas, 67068. Okay, now imagine what the accounting looks like for something like that. Okay, now put yourselves in the office of the CFO. Now you're the CFO of Phillips 66 and the year is 1985. You're like, okay, Don Cushenberry is getting ready to retire. What liability do we need to book on our balance sheet? Because we've made his family certain promises. These are legal promises. They have to go on the balance sheet. They're liabilities. You don't know how long he's gonna live. You certainly don't know how long his spouse is gonna live. You don't know what inflation's gonna be. How do you record this liability on your balance sheet? And that's just one employee. And as the CFO of Phillips 66, you know you have 10,000 employees around the world, some of which are retired today and collecting on these liabilities, some of which are still employed, but you still owe them because you know they will be retired, so you have to accrue for those liabilities. And we have a process that we go through to book that number on the balance sheet, and as you can already surmise, this process is going to be full of holes and estimates and opportunities for misstatements. And that's why, as I mentioned the last time we were together, when you have huge fluctuations in the value of your defined benefit plan liabilities, FASB allows us to take those earnings and losses and report them in a section of the income statement called accumulated other comprehensive income. So you get down to net income, and then I referred to this as the basement last time we got together. All this stuff down here that you don't want anybody paying attention to, but it matters. And we have special tax treatment associated with it. So that's the challenge at hand when it comes to accounting for defined benefit plans. And let's start with some of terminology. When we're dealing with defined benefit plans, we need to know projected benefit obligation. This is how much we think we're going to owe our employees over time. If you had to distill all that down to one number, what do we owe? It would be the projected benefit plan obligation. And that's subject to a number of estimates, ding, 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 estimates. That's your pink flag that this might be an area of accounting that could be manipulated. Number of employees who will reach retirement age while employed with the company. Most retirement plans have some rules associated with the payout of these monies that say, well, you got to work for the company for 30 years. You got to work for the company for at least X number of years. Pick a number, 10, 20, 15. The longer you work, the more benefits you accrue. Companies try to be smart about how they design some of these things. What they want to do is incentivize their employees to stick around because churn is expensive. So let's give them a benefit, but let's say that they only get that benefit if they stick around. So that's a big estimate that goes into calculating how much money you're going to owe. You have to make an assumption around how many employees are going to stick around and for how long. Salary levels at retirement. Typically, as I mentioned, the payout is a percentage of the money that you make at retirement. So what are those salaries going to be? Most employees don't stay in the same job throughout their tenure. So you have salaries that you have to forecast into the future. Those salaries are going to grow with inflation. Those salaries are going to grow as the competitive environment changes. And for any particular employee, typically they're going to advance in their career. So their individual salary will likely grow at a rate much faster than the inflation rate. Fingers crossed it will, because that means they're adding value back to the organization. Those are exactly the types of people that we want to incent and account for. Years of service, years over which those annual payments are going to be made, which was that example of 37 years for my grandmother. All of that has to be factored into our funded status. So once we have some idea of what our projected benefit obligation is, we can subtract any monies that we've put away to fund that obligation. So if we come to the determination that our projected benefit obligation is $10 billion, and we have $10 billion in our investment account that's meant to fund that obligation, well, we're square. Those two things match. Our funded status is, we call that fully funded, when the asset matches the liability. Typically, you'll see that reported on in the Wall Street Journal, Investment News. There's another one I subscribe to called U.S. Pensions. And I see this at least once every 6 months. I see a list of all the largest defined benefit programs in the country with their funded status. And that funded status is usually reported as a percentage. If you're 100% funded, assets are equal to or greater than liabilities. If you're 50% funded, well, your assets are 50% of your liabilities. Fortunately, when I was teaching this class 3 years ago, this wasn't the case. But fortunately, the bear market that we've experienced since the bottom of the great financial crisis has allowed for a triple of most investment. So we are up 300%. I think it's a little more than 300% off the lows of the great financial crisis. So most companies in the US right now are close to fully funded. We have a higher percentage of companies that are funded or close to it than we have at most points in the 20th century. 3 years ago, that number was down closer to 60%, which doesn't make you feel very good if you're about to retire and you can look up in the Wall Street Journal and see that the company you just spent 30 years working for is only 60% funded. So these things are kind of going the way of the dodo bird. They don't exist in very many places anymore. Boeing still has the largest one in the country, and they shut theirs down a few years ago. They offered everybody inside of that where you could just get a check, and in exchange for that check, they were no longer obligated to pay you out in the future. So I doubt many of you will have the opportunity to go to work for a company that offers one of these things. But if you do, one of the first things you're going to want to do is pull up that 10K filing and figure out what their funded status is, because that's going to give you some insights into whether or not that employee benefit is worth anything at all. Oh, here's a chart showing exactly what I was talking about a minute ago. Looks like I might have been a little off on my data. Looks like the low point was 76% funded. This is the median of S&P 500 companies. So you can see this was as of 18. We were at 86% funded, and the market's gone up significantly since 18. So corporate America is looking very good these days, despite the current recession. This is an example of the report you're likely to see in the back of the 10K filing. It just shows you the changes and any projected benefit obligations, changes in plan assets, any actuarial returns, so on and so forth. So make sure you're familiar with that. Then you get details on the cash flows that are going to be necessary in the short term, cash flows that are going to be necessary in the long term. That's the exact same story as the lease payments we were just talking about a moment ago. Factor those into your overall solvency analysis of any company that you might be looking at. Okay. I'm going to talk for just a moment about the components of the expense that show up on the income statement. Every year that goes by, we accrue an additional liability. When our liability goes up, that has to flow through the income statement as an expense. Any changes in assets typically associated with income, any changes in liabilities typically associated with an expense have to have a matching transaction. So when our projected benefit obligation changes, we're going to record that as a service cost or an interest cost. And the service cost is typically the cost that accrues just from the passage of time. When we estimate how an employee's salary is going to increase between now and when they retire, that estimate causes us to book an expense as each year passes. The obligation that we know we're going to have to pay increases, and therefore there's an expense associated with that. That's called service cost. Interest cost is a little bit more straightforward. We have plan assets that are expected to grow at a certain percentage rate. Typically that percent is something on par with the long run market average. For equities, that's somewhere between 9 and 11. For fixed income, that's about 5%. Most defined benefit pension plans are invested in a balanced portfolio. So if you got half your assets yielding 5 and half your assets yielding 10, then your expected rate of return is 7.5. Even that is a little aggressive when you have the current 10-year yielding 4. So I would say that your expected rate of return should be somewhere around 6. That's something else that I want all of you to check out when you're looking at your 10K in the fine print. Find out what the expected rate of return is that your company's using if they have a defined benefit plan. And if it's higher than 6, that's a little pink flag, because they're being aggressive with how much money they think they're going to make in the markets, which is fine if the markets generate that. But if the markets generate 5 and they've accounted for 6, they're going to accrue a huge loss over as time passes, because every year they're expecting 6, but they're only getting 5. So that 1% differential on a $10 billion account is real money. Then we also may see expenses associated with return on plan assets. That's an easy one. And actuarial adjustments. So if we say to ourselves, well, you know, we didn't think, my grandma's name is Virgie. We didn't think Virgie Cushenberry was going to live to be 150. Maybe we need to adjust our actuarial assumptions for everybody else we're paying out monies to. And when you make those actuarial adjustments, they're typically applied across a very large population that you're paying benefits to, and they can have a big and outsized effect. Which is one of the reasons why FASB allows us to report on those in accumulated other comprehensive income. We don't have to run those through net income. Service costs, interest costs, investment returns. Our authors give us a slide on each one of those. They give us examples of actuarial adjustments that include wage inflation, years of benefit payments, discount rate, investment returns. All of those have assumptions that are embedded in those calculations. Okay, let's talk a little bit about the smoothing mechanisms that FASB allows accountants to use, all in an effort to make the statements more useful. What they are trying to shield us from, or shield the users from, are large investment gains and losses on pension assets. So in 2008, 2009, the markets fell by 53%. Imagine if you were fully funded and the markets fell by 53%. If you didn't have some smoothing mechanism associated with that, you'd have to run what could be, I think Boeing's defined benefit pension plans up to about 70 billion. So 50% loss on 70 billion is a $35 billion loss. Well, if you put a $35 billion loss on the face of your income statement, it will make absolutely no sense when you try to look at a historical analysis of how that earnings per share number has trended over time, because you're going to get wild swings. And we want to smooth that out, while at the same time giving accountants a mechanism for keeping track of the true underlying economic reality of the business. So we smooth out the net income line and record these gains and losses and other comprehensive income. So if you just look at other comprehensive income, you will see those wild swings. They're there, you just have to know where to look. And, you know, far be it from any investing relations team or Wall Street analyst to direct your attention to the other comprehensive earning loss. What management teams are going to direct your attention to is the net income line, or better still, the pro forma adjusted earnings line that they will tell you every time is the more appropriate measure of how they've been performing, because that's what they can control. All of the other numbers are required legally to conform to GAAP. They don't have any legal control over GAAP if it weren't for the estimates that GAAP allows, which is why we have to be familiar with those, because if they can't report the numbers pro forma, and if they can't get us to focus on net income, then they will be left to answer questions from an informed analyst community about why the other comprehensive income line is so poorly performing. Net pension expense. In another effort by FASB to allow for smoothing techniques, they have come up with this calculation of net pension expense that includes service cost and interest cost, which we just talked about, fairly straightforward, less the expected return on pension plan assets, not the actual return on pension plan assets, the expected return on pension plan assets. What is the expected return on pension plan assets? Anybody, so we don't have any 401k accounts. We have investment accounts. Some of you play the stock market. Bitcoin, something. What do you expect to earn in the next 12 months? Who the hell knows? The word in and of itself means that we're trying to predict the future. What are your expectations? Well, I don't know. I can't predict the future. So typically what you'll see is that expected rate of return is tied to some long run average. We can say, well, the long run average on US stocks has been 9 to 10%. So we're going to take 9%. The long run average on fixed income securities has been 4 to 5%. So we're going to use 4%. Pretty reasonable. But that doesn't mean that's what you have to do to figure out what an expected rate of return is. You can come up with just about any analysis framework that you want to justify a higher or lower expected return. That should be disclosed in the back of the 10K, should be in the fine print. That's your job as the analyst to go looking for it, understand how it was calculated, and then to call BS if you need to call BS on an aggressive calculation of expected return. And then lastly, there's any amortization of deferred amounts, if any. What is a deferred amount? What might we defer? We might defer, and we would. This is how you account for it. Any actuarial changes that result in a gain or loss. So actuarial changes are deferred over time. And FASB allows you to amortize those over a certain period. And those are the 4 elements of pension expense that actually show up on the balance sheet. Income statement, excuse me. Slide number 44 is a great slide. Star that one. I think that's it for pension account. Which should give us 20 minutes for analyze and interpret income tax reporting. Let's do it. This is not my favorite. Okay. Concept number 1. Every company has 2 sets of books. One book that they have to use GAAP accounting for, adhere to all the legal standards that make financial statements useful for the general public and analysts and internal corporate M&A, so on and so forth. And a second set of books to adhere to all of the various standards that are superimposed by the IRS. And the IRS has different goals than FASB does. GAAP, the system of GAAP, generally accepted accounting practices, is meant to create usability, to create measurability, and adhere to the 3 or 4 other accounting principles that you all learned in your accounting 101 class. And it does a pretty good job. The IRS doesn't care about any of that. The IRS cares about accurately collecting the tax revenues that shake out of the way the Internal Revenue Code has been designed by our regulatory bodies. So, several years ago, the state of Missouri told all business owners in the state of Missouri that there were certain tax credits, rebates, and accelerated depreciation schedules available to any business that wanted to opt into a renewable energy strategy. So you could go out and you could buy solar panels, you could buy, I think windows were a part of this, you know, there were a whole range of renewable energy initiatives that the state of Missouri was trying to encourage. And if you spent money on those, you got a tax break. Well, that was not in accordance with GAAP. And an accelerated tax depreciation schedule that was made available by the IRS or the state of Missouri in this instance. It would have been appropriate to calculate that your IRS books so that you accurately reflect your tax expense. But it would have been entirely inappropriate to record that on your GAAP books because it's inconsistent with general accounting principles. So that's not an incredibly clear example of how you get different accounting treatment from IRS and GAAP books, but let's see if we can't look at it in more detail. And the depreciation example is the most common, which is why we start with that one. So let's assume, and we'll walk through this, let's assume Southwest Airlines purchases an asset with a 5-year life. Southwest Airlines has the choice of how they want to depreciate that asset for GAAP purposes. And they also have the choice of how they want to depreciate that asset on their financials that they share with the IRS. Okay. So in this example, we're going to use straight line depreciation for GAAP, and we're going to use an accelerated method of depreciation for IRS tax purposes. Why would we use an accelerated method when we're reporting to the IRS? We do that for a reason. Any thoughts on the reason?
Save on the tax liability for that year.
Yeah, anytime we have the opportunity to book a bigger expense on our IRS books, we want to book that bigger expense because it's going to make the tax expense smaller. So revenue minus expenses equals taxable income. What we want to do is make that taxable income as small as we can possibly make it, because the next line item on those books is tax expense, usually at 35% corporate tax rate. Now, we don't have the same incentive to minimize our income for GAAP. For GAAP, if we use a straight line depreciation method, you might argue that that's more accurate and a better reflection of the underlying economic reality. Or you might argue that if you use straight line, your earnings per share number is going to be a little bit higher. That's that game of find the penny we were talking about just a moment ago. So there's lots of reasons why you want to use straight line for GAAP and an accelerated method when reporting to the IRS. The point is that's going to create different accounting. So what you see here is that during the first 2.5 years, the number we report to the IRS is going to be higher than the number that we report utilizing GAAP. And then that's going to reverse itself over time because the accelerated method of depreciation is going to accelerate the method. And then later in the years, later in the useful life of that asset, we're going to see the straight line a little bit higher than the accelerated depreciation method. And here's what happens. So here we have the financial reporting on the left. So this is GAAP. We have tax reporting on the right. So this is IRS. You can see that we have income before depreciation of 200. Our depreciation for GAAP is 50 based on straight line. Our depreciation for tax reporting is 75 based on an accelerated schedule. That gets us down to earnings before tax. So GAAP, we have earnings of 150. Tax reporting, we have earnings of 125. It's the tax reporting that determines our cash out the door. We have a tax expense of 50. So that's what we actually pay. That's our cash paid. But over here, what we book an expense of 60. So we've booked an expense of 60, but we've actually only paid. So our net income differs from 90 to 75. So what we've done is we've booked more than we paid. And that creates a liability on our books that we will refer to as a deferred tax liability. We didn't book for GAAP. Or we didn't pay the IRS everything that we booked here. So the difference has to be a liability that we will pay in the future. So that flows through to our balance sheet, to our income statement, and in later years, we're going to see that reverse. So this is year 2. In year 2, we have the same depreciation, $200 worth of depreciation on both financial reporting and tax reporting. We have $25 worth of depreciation for tax reporting and $50 worth of depreciation for financial reporting, resulting in income before tax of 150 for GAAP, 175 to the IRS. Our income tax is exactly the same here. But now we pay 70 to the IRS. And in doing so, our deferred tax asset is going to decrease. I said deferred tax asset, I meant deferred tax liability. So let me go back a slide. On this slide, we created a deferred tax liability because these two numbers didn't match. In the following slide, the effect is reversed. So we credit the deferred tax liability and it will effectively go away on our books.
If we have no deferred tax liability at this stage, then deferred tax asset would have been created.
Say that again.
If at this stage we had zero deferred tax liability, and that's the scenario, then the deferred tax asset would have been created at this stage, right?
The deferred tax asset, but yeah. So,
Yes.
okay, yeah. I feel like you're ahead of the.
Well, actually, I have some concept of that in CA.
Okay. You're doing really well to grasp that at this point in the class. The deferred tax asset is just the inverse of the deferred tax liability. And we're going to look at an example of that next. So a deferred tax asset will arise when the tax payment is greater than the tax expense for financial reporting purposes. There are lots of instances where this might be factored into place. We're going to look at one called net operating losses. You might also think of this as prepaid taxes. You know, that's how you get prepaid insurance, shows up as an asset on your balance sheet. Anytime we pay a tax, that's a little bit, we pay more today than we will have to in the future. That's similarly going to create a prepaid asset that we refer to as a deferred tax asset. Our authors give us several examples of this on slide 62. Restructuring accruals, timing differentials, net operating loss carry forwards are Another area where we see this quite a bit. Let's see if we have. To star, your deferred tax asset is the future estimated tax deductible expense or loss times your tax rate, and then the deferred tax liability is just your future estimated taxable income. I thought our authors had given us an example to walk through showing that deferred tax asset, but maybe not. Okay. Well, then let's skip to exhibit 10.5, and you can see here how these are typically reported in a 10K file. You're going to see deferred tax assets and how they're broken out across 6 or 8 or 10 different categories, and these can be associated with, in this instance, we have a tax loss carry forward, we have intercompany transactions, fixed assets, warranty expense, employee and retiree benefits, deferred revenue, other, almost every aspect of accounting that you can think of can have different treatment at the financial accounting level versus the IRS level. And all of these different timing differentials can result in deferred tax assets and deferred tax liabilities. Conceptually, that's what you all need to take away from this class. And the notion that they'll all be broken out for you on a table in the back of the 10K file, so that you can see how each of these move from year to year to year. That's when the element of materiality comes back in. I don't expect for you to have a firm grasp on the tax accounting associated with warranty timing differentials. I don't expect for you to have a firm grasp on the tax accounting associated with intercompany transactions. That's a little bit beyond the scope of this class. What I do expect you to have a firm grasp on is the notion of whether or not something's material. So if this warranty number was 99% of the deferred tax asset balance, so now you're up around 8 billion or something like that. Okay, all of a sudden that becomes material. And it's your job as the analyst to go do some digging. You're all smart enough to be able to read the fine print and educate yourselves on exactly what that means when warranty or any other of these line items substantiate 80 to 90% of what's going on in those deferred tax assets, and whether or not those deferred tax assets and deferred tax liabilities are meaningful to your ultimate use case analysis of your buy, hold, sells. Okay, let's talk about evaluation allowance. I mentioned that net operating loss carryforwards can create a deferred tax asset on your balance sheet. So when a company loses money in a particular year, the IRS says that you can take those losses, carry them forward to future years, and use them to offset tax liabilities. So that's a deferred tax asset. That's of real value. Those losses are of real value in future years. I want you to understand the concept of evaluation allowance. The IRS and FASB, they say that, that those net operating loss carryforwards are deferred tax assets if and only if there's a reasonable expectation that the company will be profitable in future years. If there's not a reasonable expectation that a company will be profitable in future years, think of something like, I don't know, the first example that comes to mind is Pets.com. Anybody remember Pets.com? It's one of the businesses that went bankrupt in the dot-com era. Anything with a .com after its name was going gangbusters in the late 90s, early 2000s. And Pets.com was one of these stocks that took off. But they didn't have a real business model, and they were hemorrhaging money. And this is, lots of companies were hemorrhaging money during this period of time. You didn't need to particularly show any kind of revenue growth plan. You just needed to show and hype up the fact that you were on the internet and going to benefit from huge future productivity gains that were front and center in everybody's mind because they thought the internet was going to revolutionize business, whatever. Well, if there's no real future for a business, you can't foresee that on the horizon with any degree of expectation, then FASB says that you have to book a valuation allowance against that deferred tax asset. So if you've lost money for 3 years in a row and you have a deferred tax asset on your books that says in the future you're going to be able to lower your tax liability, and that deferred tax asset is worth $1 million, but you don't have enough visibility into that future to predict that you'll have profits to utilize that, then your accountants at Ernst & Young or Deloitte & Touche, they're going to come to you and they're going to say, you really need to book a valuation. If any of you see a valuation allowance booked it against a deferred tax asset for the companies that you're working on, that's a huge red flag. Because that means your auditors are telling you directly, we don't expect you to be profitable. You haven't shown us an adequate business plan that gives us confidence in the notion you'll have profits in the future. And without profits in the future, that deferred tax asset that you're telling us is going to offset future tax liability is no good because you won't have the profits. So that's a huge red flag. I want you all to know what that is. I want you all to be able to recognize that and be mindful of it if you see it. Slide number 67 shows how that's likely to be disclosed. Slide number 68 shows a reconciliation between taxes that are currently payable and taxes that have been deferred. This is another area that can get very complicated very quickly. This slide shows US federal, non-US and state taxes, but there may be jurisdictions around the globe for some of these multinationals. So that's a table that can be very informative. Slide number 70 shows a reconciliation of how each of these line items might affect the effective tax rate. So this is a good table to reference. Like you can see here in 2018, I think are we still looking at Microsoft? I'm not sure. You can see that the statutory tax rate went from 35% in 16 to 35% in 17 to 23% in 18. And that's not uncommon. The statutory tax rate is 35%, but I think the average effective tax rate is somewhere in the low 20s. So this table will show you exactly how a company goes from 35 to 23. So you can see here that lower rates in other jurisdictions lowered the effective tax rate by 10%. So if you're looking at a global multinational business and you're thinking to yourself, okay, corporate tax rate should be 35%. Well, yes, it is 35%, maybe in the US, but they do so much business outside of the US, it has a negative effect on their total average tax rate that amounts to 10.9 percentage points. Here's one, US tax reform impacts, lowered that by 35.8. And then get all the way down here. Well, what is this? So their tax rate went from 29, an average of 29 in 2016 after all these adjustments, 22 in 2017 to a negative 76.8. In 2018, looks like the biggest factor there was uncertain tax provisions and audit settlements. So they had a big legal settlement, it looks like, that lowered that tax rate. And that's all going to be disclosed in the fine print. So now you probably have 10 or 20 pages to dig into to really understand what's going on there. And like gonna repeat in future years or needs to have other adjustments made for it and reconciling the accounting so you can have apples to apples across historical or peer group review analysis.
What does that mean when they have a negative effective tax rate though?
Well, it could mean that they booked a huge deferred tax asset, or it could mean that the IRS wrote them a check.
Oh, okay, got it.
And we are at time, and that was the last slide I wanted to comment on anyway, so we made it. All right. Happy Halloween, y'all. Appreciate you sticking with me through our most technically challenging lecture of the semester. Next week begins the transition from accounting to finance. This whole class is the intersection of accounting and finance. We've spent the first 10 weeks taking a pretty deep dive into just general strategy, if you go all the way back to quarters, five forces, and SWOT, and then quickly moving into analysis of the balance sheet, income statement, cash flows, and some specific accounting treatment. Next week, we're going to transition a little bit, talk about how we take everything that we've learned, recast the financials, forecast those into the future, and then it'll be heavy finance from here on out as we talk about discounted cash flow analysis, peer group analysis, how we really put a value on everything that we now know from looking at the account. I am out next week, so I think we go 2 weeks before we're on ground again. So I'll see you in 2 weeks.
Thank you.
Oh, then 3 weeks, yeah. It's, the syllabus is accurate, so check that. I'll see you on the next day.